Okay, what we want to do at this point is use this accounting equation to account for our first set of transactions. And we're going to block out the remaining 5 here and just focus on the first one for now. So the first thing that we do on January 1st is receive $1,000 in our business checking account from an owner's personal checking account. So the first thing we do is look to the left side and say, what happened to the cash account? Well, in this case, the cash account went up $1,000, so we put the 1,000 here. Now, on the right side of the accounting equation, we are asking the question, who has claim to those assets? So we're saying for this $1,000, who has claim to it? Do any of our creditors, like a credit card company, do they have claim to the 1,000? Of course not, because it came from an owner's personal account. The owners here in the owner's equity section, they have claim to it. So we put the 1,000 here. Our second transaction occurred on February 1st. We received $500 in our business checking account by charging $500 on the business credit card. So we'll start on the left side. Assets went up by 500, so we put the 500 there. Our running balance, of course, is increased from the 1,000. We add the 500, and now we have a cumulative total of 1,500. On the right side of the accounting equation, again, we're asking the question, who has claim to those assets? Do our creditors have claim to those assets? This 500 in particular? Well, yes, they do. We owe the credit card company another $500, so we're going to put the 500 here. There wasn't any change to owner's equity on February 1st, so we don't put anything here, and we just carry forward the balance from the previous transaction to the running balance as of February 1st. And of course, notice our accounting equation is always in balance. Even from the transaction level, the 500 on February 1st equals the plus 500 over here. And the running balance of plus 1,500 equals the running balance of 500 plus the running balance of 1,000 over here. So we're always in balance. Moving on to our third transaction that occurred on March 1st, we paid $400 from business checking for coffee received from a vendor. So here on the left side, our asset account, cash in this case, went down $400. So we put the minus 400 here. Our running balance went from 1,500 down to only 1,100. On the right side of the accounting equation, again, we're asking who has claim to those assets. Well, this 400 on the right side, who has claim to that 400? Well, did we use the 400 to pay off our creditors? No, we didn't, so we don't put anything here in the liabilities account. The owners of the business, they have 400 less in ownership interest of the business, so we're going to put the negative 400 here. Moving on to April 1st, we received $600 in business checking for legal services that we performed for one of our customers. So start on the left, the cash account went up $600. So we put the 600 there. What happened on the right side when we asked the question, who has claim to those assets? Well, there wasn't any change with liabilities in our credit card, but the owners of the business, they have another $600 of ownership interest in the business, so we'll put the 600 here. And as always, the accounting equation is in balance, plus 600 on the left side, plus 600 on the right side for April 1st. Moving on to May 1st, we used $500 from our business checking account to pay off the business credit card balance. So on the left side, what happened to the asset account cash? It went down $500, so we put the negative $500 here. On the right side, when we're asking who has claim to those assets, well, the credit card company was paid off. So we had, before this transaction, we had a $500 debt to the credit card company, but that debt was reduced by $500. So we put the negative 500 here such that as of May 1st, the cumulative balance is now 0. And as always, the left and right sides of the accounting equation are in balance. Negative 500 equals negative 500. Now the last transaction in our example here is June 1st. We withdrew all $1,200 from business checking to pay the owners of the business. So we start on the left side with the asset account cash. It went down $1,200, so we put the minus $1,200 here. We've got the balance of 0 as of June 1st. And then on the right side, we're asking the question, who has claim to those assets? Well, there wasn't any change in our credit card account balance. It's still 0. Over here with owner's equity, we see that yes, the owners of the business have $1,200 fewer in ownership interest of the business. So we put the minus $1,200 here, and the cumulative balance as of June 1st in the owner's equity account is now 0. So we've added this blue box here on the right side to just ask some questions as we think through what this accounting equation framework is showing us as we record all these transactions. If you think back to the second slide showing the overall purpose of accounting, where we saw that we wanted to provide information for making decisions and we wanted to provide financial position, assets, liabilities, and owner's equity as of a point in time, well, we can ask the question, does this accounting equation framework that we see here show us that? Well, let's take June 1st, for example. On June 1st, this point in time, can we see assets, liabilities, and owner's equity? Absolutely. So the answer to that question is yes. However, the second main kind of accounting information that we really need to produce is financial performance, and that was showing us the revenues, expenses, and net income over a period of time. When we ask the question, does this accounting equation framework show us that? If we didn't have these descriptions here, and all we had were these account names and the numbers that we see, if that's all we had, would we be able to look at this and say, hey, these are the revenues and these are the expenses? We wouldn't. So the answer is actually no. Now, when we look at the descriptions here, we can see that yes, this is revenue, because as we learned earlier, when we sell goods and services to customers, that's revenue. So this 600 is revenue, so we know that from the description. And then from this description, we can see, since we paid out money to a vendor for services or goods, that is an expense. So we can see that the 400 is an expense here. But if we didn't have these descriptions, we wouldn't be able to just look at this owner's equity account balance running total here and say this one is revenue, this one is an expense. So we really couldn't provide that information that we need to be able to provide. So what we're going to do is modify the accounting equation framework here a little bit so that we can easily see that information. So we've modified the right side of the accounting equation in this slide by saying, okay, when it comes to owner's equity, assets minus liabilities, we do have 4 different kinds of owner's equity accounts that we're using. Owners can invest in the business, they can make withdrawals from the business, and then we can also get monies coming in from sales to customers, revenues here, and we can also pay out money for expenses, and that can be shown here. Each of these 4 buckets, if you will, they are a part of owner's equity. So when we show them this way as opposed to the way we saw earlier, we can easily see just these items in yellow. We can see what our revenues and expenses were, and then if we subtract expenses from revenues, we can calculate net income. So for example, from the period January 1st through June 1st, we had 600 in revenue and we had 400 in expenses. So it's very easy to see with this framework, and we're going to use this going forward.